What is up, YouTube? What is up, guys? The Composer Trader here, and welcome back to another post trading analysis video. And today we're going to be discussing a short setup that I took on HBAR, and I actually took this around the same time that we shorted that bearish PO3 on ETH, which was the previous video. And I actually took this trade live on stream inside of the TCT trading community, and funny enough, it was actually recommended by another TCT member in the chat who told me to check out HBAR, because if you've been following me for a while, you know HBAR is not typically a trading pair that I watch and that I actively trade. So someone told me to check out HBAR. We saw the model, we saw TCT within TCT, we entered, and it was an amazing trade. Now, I'm only making this video right now because I was still in the position. I had still around 30% left. That got stopped at break even on the current move up. So now, since the trade has fully played out, we can properly reflect back and talk about the setup. So let's dive deep into all the technical moving parts behind me taking this trade. So as always, let's build some context. And the context regarding HBAR was that it was truly doing absolutely nothing until it got a very aggressive liquidity injection, causing price to pump around 845% in the span of just 35 days. Absolutely insane. And overall, when prices are pumping up this aggressively and you create your first range, the macro expectation of this range is to break towards the upside because of the aggressive push up that you had, right? Also, given the context of where crypto is in general, we're in this state where I am expecting higher prices. If you get that massive liquidity injection in HBAR, kind of showcasing that, hey, I'm not a coin that's dead and forgotten. I'm actually here to stay and to perform coming into this cycle in 2025 as well. You're expecting that macro range to break towards the upside. Now, that doesn't mean that we still can trade shorts, okay? It just needs to be high probability models. It's that simple. Now, looking at the structure, we see that our main market structure, also referred to as your level 1 market structure, is pointing up right here. Aggressive push up, daily market structure following the 6 candle rule that's explained in the mentorship. And from there, we create a range. But as you guys always know, we can have different levels of market structure. So your level 1 market structure might be pointing up, but you also have market structure from the top down that's obviously then pointing down. So we had low, lower high, and lower low. Let's make that red right here. Make that red as well. So you can kind of visualize you have level 1 market structure pointing up, level 2 market structure pointing down, okay? And when I'm looking for my local plays, I'm always looking at the most local range to find my entry on, to then taken towards a potential bigger range creation or just overall a breakout if we get it. So when I see this range, yes, it is valid to pull your range from top to bottom following your high time frame. But if you have to look at which range is better, this range right here, and obviously you have to look at it from at that point in time when we took the entry, right? So right here we took that entry. Which range looks better to use? This range right here, where you barely have any price action in the upper section of the range, or you follow your red market structure drawing and you follow that local downtrend, causing you to pull your range from bottom to top. And then you actually have this as your range, where you can see this is actually the range because price hasn't traded outside of that range. We had one deviation and then that's it. So this was the better range to look at, and that's also you just having to be rational, okay? Both ranges are valid, but this is the better range to be looking at, and this also allowed you to short that distribution, okay? So following that local downtrend, pull my range from low to high, and we had just overall a very good looking range, right? We had an initial range low, we had an initial range high, we front ran that low right here, and then we deviated that high, kind of creating equal lows right here, which can be a liquidity target. Now, I do have to mention that on some other exchanges, we did actually sweep this low. So I took that, I had it in the back of my mind. I purely tried to put my focus on the Bybit charts only because based on data and experience, they have the best charts from just an accuracy standpoint. So I typically don't really use that other chart swept the low and then Bybit didn't, blah, 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 blah. But since it was this close, I kept it in the back of my mind just to be sure. Okay. After the deviation of the high, we extend our range high to the deviation high. And immediately, the moment we deviate that high, we're looking for potential distribution models to create. Okay. So we're going to kind of check where could be that POI that can validate our third tap from a model 2 standpoint. And obviously, if we sweep the range high, that will make it a model 1. So scanning through the time frames, we can see right here on the 2-hour that right in that pivot point that created the deviation, we have this valid order block right here. Right there. And then also is looking at it from an extreme liquidity perspective, following your structure from top to bottom. You have a low, lower high, lower low. This is that first market structure high that got created, therefore being your extreme liquidity, and that got swept right there. So I always like it when I have my extreme liquidity sweep prior to my extreme supply, where price can kind of sweep that liquidity coming into the supply, mitigating and sweeping both, and then potentially dump back down. It just makes for the most optimal third tap POIs because it's just so clean. Obvious liquidity point with obvious supply above. So from a high time frame context standpoint, we come into premium pricing, and if we tap this right here, this can validate our third tap from a 1, a 2, and a 3, where the target would obviously be the range low, which is the technical target. Okay. Now, this range itself, I wouldn't have traded it solely based off a breakup structure back to bearish, which usually confirms your model 2 distributions. And the reason for that is because you didn't have a proper return to zone coming all the way from these lows up towards that breakup structure high right there. Okay. Because as you can see, we had some demand creations on the 3-hour at extreme discount right here, while also having demand creations right here. Okay. So you can see we have these two demand creations and not that really curvature up effect that I'm always looking for. So therefore, I wouldn't trade it based off a simple breakup structure. Okay. Because it's not a high probability model. It looks good, but it's not a high probability model. So if I'm going to trade this, I want to see a TCT within a TCT model where the low time frame TCT model ends up being a high probability model. Okay. So right here, coming into that third tap, what we actually had was a range creation. So we're going to zoom in on our range because on the 3-hour, it kind of looks like a 2-tap model. But if you zoom in, you'll see that there's actually more going on the lower time frames. So zooming into this range, we can see prices were making higher lows and higher highs coming towards that POI right here. Now, when you're trending up, you pull your range from top to bottom, and you can see that this is actually your range, okay? And then you have a range high, you have a range low, and then you deviate the high right here, okay? Where that second tap of this potential redistribution model can be the third tap of the high time frame distribution model. Again, TCT within TCT. If you don't fully understand that, it's in the advanced TCT schematic lecture, which is around, I think, lecture 6 of the TCT mentorship that you can find on this YouTube channel, just under the playlist section. Okay. So we're going to make these dots blue as well to kind of show you that there are different models within models. And then you can see coming towards that high, you actually have a very good looking return to zone. Like this is actually a proper return to zone building up right here. Boom. Okay. Where you can truly see from the start to the high, from the low to the high, you actually have those lows all curving up to be higher lows compared to the previous one, where people that long in here and long in here, they tend to put their stop loss below the previous swing lows, which are right here. So anybody that longed has put their stop loss below all these previous swing lows, And then once one of those lows get taken like this, it causes a liquidation move down, where the move down causes all these stop losses to get triggered. People that are long, when their stop loss gets triggered, let's say the stop loss is here, and the stop loss gets triggered and they're long, that causes a sell order. And that sell order is going to spike price down. And if you have another liquidity level right here, that spike down can cause the stop losses underneath that other liquidity to also get triggered, that cause another spike down. And you have this snowball effect of liquidations that can be extremely fast. So the fast move doesn't have to be people selling, it's actually people getting stopped out of their positions. And looking on the right, you can see how fast that move down actually was, which was just solely based off a lot of liquidations. Now, if we zoom in here on the 30-minute, you can actually see that if we have to validate where our potential third tap could take place from a Model 2 distribution standpoint, you have to check, okay, what is kind of that first market structure high that got created? We have a high, we have a low, lower high, lower low. So this would be that first market structure high, and therefore also the extreme liquidity POI. But, you have to sweep either extreme liquidity and or extreme supply. And in this case, the supply was actually below your extreme liquidity. So just like how I said, how I prefer my liquidity to be below the supply, you can also have your liquidity above the supply. Okay, you can see that right here, and you can compare that to the higher time frame model, where right here you have the liquidity prior to the coming into supply. Here you have the supply prior to the liquidity. So I do prefer it to be the other way around, but doesn't mean that we can't still take the trade if it's valid to do so. Now, price came down, came back up, and right here when we're mitigating that supply, that is validating our potential third tap from a Model 2 distribution standpoint. So in order to confirm our third tap from a Model 2 distribution standpoint, we have to check what's the lowest point that price has traded between tap 2 and tap 3. So we have tap 1, we have tap 2, and we have tap 3. The lowest point that price has traded between tap 2 and tap 3 is right here. Now we're going to zoom in this market structure low to that market structure high, and we're going to watch for a low time frame market structure in that local uptrend. And if that breaks back to bearish, that confirms the schematic. So when that breaks back to bearish, that confirms that price is going to come towards the range low, which is the technical target of the distribution. Okay, so knowing this, we're going to zoom in on the lower time frame. Where were we? Right here on the left. There you go. So as you can see here, price locally from this bottom to the top was making higher lows and higher highs. Did this go higher? Yeah, higher lows and higher highs just like this. And this was our market structure low. So when we close below that market structure low, our Model 2 distribution gets confirmed. And right here, you can see we get these closes below. Right on that close, we can go short. Stop loss goes above the third tap high, which is the invalidation. And the technical target is the distribution and the range low of that distribution model, which will be right here. Now, that is obviously the technical target. Looking a bit lower, you can see that on the left here, there is nothing but sell side liquidity. So you can actually extend your target also to there, but you can extend your target even more because we're trading TCT within TCT, where this local distribution model can be the third tap of the higher time frame distribution model, kind of separated into the red dots and then the blue dots, right? So this is the total setup. Now, I was obviously aware of the different demand zones that we had in here and in here, while also being aware of the fact that MEXC and other exchanges did sweep that low. I was taking partial profits in here, and then actually right here. So I got 3 TPs that were getting triggered, 1, 2, and then right 3, which was at its liquidity low. And I still had 30% in the position, but then the moment price is making lower highs and lower lows, obviously I'm trailing my stop to break even. And then on that move back up, where markets were turning bullish again and Bitcoin also deviating that high time frame range low, I got stopped at break even on the rest, but it netted me over 7% in a single trade. Okay, absolutely beauty of a schematic. 7% gain, more than your weekly profit target. It's all that you need. A few high probability models, and you are done. Okay, you can compound that over time, and trust me, guys, the money that can be made is more than you can imagine right now. Now, one thing I want to talk about on the schematic itself is that tab 2 and tab 3 are very close in price. So you can see the distance between tab 1 and your tab 2 is way bigger than the distance from a timing perspective between your tab 2 and your tab 3. And if you go on a higher time frame, these tabs also merge into one tab, where your tab 2 and your tab 3 kind of disappear. Not on the 1 hour, it's still valid on the 1, but on the 2 hour, they kind of disappear and merge into one tab. When you're trading tabs where your tab 2 and your tab 3 are closer to each other, or compared between the ratio between 1 and 2, tab 2 and tab 3 are extremely more close than tab 1 and tab 2. The only way you can still take the trade is if you have a good return to zone. That has to be a requirement, okay? Because then you're expecting the flush. The moment you break structure and the moment you leave that liquidity trail that's curving up, you're expecting a flush down, a liquidity flush. So if you're trading two tabs that are closer to each other, your tab 2 and your tab 3, you need to have an extremely good looking return to zone. If that's not the case, you shouldn't be trading this. Because then what can happen is that you have your tab 1, you have your tab 2, and then price just goes up for a proper tab 3 on the higher time frame that can be a model 1 or even a model 2 like this, okay? That is not going to happen if price is having the ability to flush down because of the good looking return to zone. So only if you have a good looking return to zone can you trade your tab 2 and your tab 3 that are closer to each other and also can merge into one tab on the higher time frame. Now, if, for example, price wick that low and then end up coming higher, you just have to take the L and then get the W if you get a reconfirmation where price end up coming for the extreme liquidity. And now on the higher time frame, you also actually have some better time displacement between tab 2 and tab 3. Okay? But that didn't happen because the return to zone was so amazing that causes that liquidation flush down. So if you're trading tab 2 and tab 3, they're closer and merge into one tab on the higher time frame, having a quality return to zone is a priority and a must. Okay? So kind of reaccumulated here, had a range, never mitigated that extreme demand right there, and then we moved up higher because, like we just said in the beginning of the video as well, overall, you should expect this range to break towards the upside, given the context that we just pumped 800%, kind of HBAR solidifying itself that is here to stay for the rest of the cycle. So guys, you can see again, it's a TCT within a TCT model, where the low time frame was a high probability model that we took in context that was also in our favor. So netted me around 7%. And if you like my style of trading, if you like my style of teaching, you're going to love the Discord even more. We're trading there every day live. People are absolutely smashing it in the server, trading the TCT models. Me also giving live educational content, private educational content. People's equity trends are going up and up, taking absolutely amazing trades. They're even taking trades without my help and without my mentoring. You can see we nailed that PO3 inside of the server as well. It's an absolute amazing server. People are here to help you. Prop firms are getting passed. Funnel challenges are getting completed. Absolutely amazing. All helping each other, all wanting to be better. Community of like-minded people. Shout out to Mr. Raquin as well. Reached his goal of getting his 200K funded account. Just imagine what that could do to you guys. Getting your 200K funded account where you can take a trade like this, make a 7% net gain, and net 14K. Okay, so if you're liking these videos, if you're not in the Discord already, give it a shot, test it out. You can never go wrong with just trying it out. And I hope to see you all in the New York Open live stream, because I'm going to be live streaming in a few hours. Okay, peace out, guys.